Hey everyone, Logan Hertz here with Hazeltine LLC. We are back again with Mr. DeAndre Clayton to continue answering some of the First Lien HELOC velocity banking objections. And since I'm not the resident expert, I'll bring in the guy who is the resident expert. DeAndre, thanks for joining us today.
What's going on, Logan? How you doing today?
Doing well, doing well. Okay, so this I think is part three, and these are going to be a new set of comments from a different user than last one. So let's just jump right into it. These are comments from a video that one of the first ones that DeAndre and I did together talking about the first lien HELOC. And I'm going to let DeAndre do most of the answering, most of the talking here. He says, I wonder why there is not an apples to apples comparison. So you are comparing a $270,000 mortgage at 4% to a $220,000 HELOC at 7.5%. So
Gotcha.
this was an example that DeAndre went through as part of the presentation, as part of explaining velocity banking, how it works, how the first lien HELOC works. Okay. And so he goes through a few things, basically saying that look, you're not doing an apples to apples comparison, DeAndre. Okay. The principal amount, $270,000 on the mortgage, is higher than the principal amount, $220,000 in the HELOC. So of course the HELOC is going to look better, DeAndre. You want to address that?
Yeah, so I can definitely address that, and I'll go ahead and say I understand your confusion in this regard. Sometimes when you're dealing with personal finance, you may forget the part of personal, right? And one thing that was personal about it that he may have missed when he looked at it was that we were not starting the original loan off at 30 years. We were starting it off at 22 years. So basically, when I'm meeting this client, they are already 8 years into the loan.
Hey, scroll up to
Um,
the top, DeAndre, so they can see
oh,
the numbers that,
okay,
yeah, those are
wonderful.
different
Yeah.
numbers.
So these were
So
the
there,
numbers.
so on the left-hand side, there you see on the mortgage, $270,000
Right,
versus on the HELOC, $222,000.
right.
So you can see how someone might be confused, right?
Definitely
They'll, s-
could.
yeah, they'll say, well, "Wait a minute, man, you're not making a fair comparison, right?" So really, what it should say on the left-hand side is really it should say the original loan amount on the mortgage because we are based on those number of payments, we're a few years into that 30-year term, right?
Right, correct. Yeah. So we're already 8 years into the loan. So when the client is meeting me, they're meeting me having already, gone through 8 years of the amortization schedule and having paid down the property to that extent. So the 48,000 didn't mysteriously disappear. The client is looking to pay off the remainder of their property with the 222,000. So when the loan is being replaced, it only is replacing what actually is there. Now, could it replace more? Yes, it absolutely could replace more if the client had a certain amount of debt. Maybe if they had 35,000, $40,000 of credit card debt or something like that. Certainly, I could have added that to the top of the loan as well. But just for context, I wanted to make sure that that was very clear in reference to why it was 270 versus 222. Yeah, because we're basing it on them already having been in the loan for an extended period of time, right? And during that extended period of time, now we are saying, hey, this is what the whole schedule looked like. Because when you're doing these calculations, you're focusing on what is the total cost of the mortgage, not what is the cost of the mortgage that's remaining. And if you were to say, hey, that's apples to apples, oranges to oranges, or whatever type of comparison, the hard part about doing it from a remaining standpoint is I can't really replicate where the amortization schedule is in the calculator without stressing what the actual total amount of the loan was to start off with. So if I started it at 222 and you're 8 years in, obviously that would be also incorrect as well. So I just want to make sure that we kind of have some clarity there. Was there any other confusions about it per se in reference to that?
Well, I think this subtly actually kind of emphasizes one of the benefits of the first lien HELOC is that it is much simpler.
Hmm.
Because with the first lien HELOC, you just say, well, here's the principal amount, right?
Right.
And it's a simple interest rate. Whereas to your point, because of the amortization schedule, it makes a big difference whether you're on your first year of a mortgage or
It
whether
does.
you're on your eighth year or your 15th year, right? The further you get along that amortization schedule, the more money is going to principal rather than interest. Whereas with
Absolutely.
the first lien HELOC, it's a priority principal loan from day one. So the money you dump in goes straight to principal, right? Rather
Yeah.
than to interest.
Absolutely. Absolutely. So if a person wanted to know the math, if they were just kind of like, hey, well, what does it look like from the standpoint of what I have left? I could simply say, okay, well, you're at 222 right now, and then scroll from that 222 standpoint as far as how many more months they would have left on it. Right. So
Mhm.
if we're looking at month 68 as being when they started, and we just went all the way down to the end of the end of the loan is month 263, right? So just kind of
Mhm.
break down the math of 263 minus, you know, minus 68. You have 195 months left, right? Right. So if I was using that as a comparison, that's kind of what's actually going on in this particular example. But if I was looking here at the HELOC and I'm starting from where it's a 70-month comparison. So I hope that helps to provide a little bit of clarity. But one thing I want to really answer in reference to that is I'll do a couple different things just to show the power of the first lien HELOC. So one, I'll go ahead and throw this number back up to 270,000 for the client's sake, right? And I'm going to do this twice. One, I'm going to show him at 270,000 and I'm going to give him the benefit of the doubt that he's 8 years into the loan. So this is not an apples to apples comparison. This is actually putting the HELOC in a worse predicament than the mortgage, right? It's giving the mortgage an 8-year head start. Well, what would happen? Are we looking at the numbers here? Right? This is an 8-year head start on the mortgage. Still same amount borrowed, 270 and 270. This is also not apples to apples because I'm not including the amortization schedule. Now, if I went ahead and said, hey, let's go even further, I want you to take a screenshot of this number. At 8 years, it's equivalent to $136,425 of interest. Now, let's go up and make this 30 years, right? So this is the apples to apples comparison I think that people want. I'm buying a house inside of a first lien HELOC, right? And I'm buying a mortgage at this interest rate that I have that is a 4% interest rate in comparison to the 7.5. Hey, DeAndre, there's no way you were doing a illegitimate, you were doing a fair, you were doing an unfair illustration. People, I'm doing real life illustrations based on what my clients have left on the loan. They're concerned about what they're paying off, right? Not what was there, but what they're paying off. So I just want to make sure that's clear. But now, if we actually did this brand new to brand new,
Mhm.
Logan, what do you see?
Well, the equivalent 30-year mortgage amortized interest rate on the first lien HELOC is actually less than 2%. So the first lien, that's what I always go to because I think people need to understand, they need to contextualize numbers. So people will say, well, it doesn't make sense to take out a first lien HELOC at 7.5% when you could take out a mortgage at 4%, not understanding that the 4% mortgage is amortized, whereas the
Mm-hmm.
7.5% on the first lien HELOC is simple. So if
Mm-hmm.
we make it a truly apples to apples comparison, it's actually 4% on the mortgage versus 1.9%
Mhm.
on the first lien HELOC. Because so
Right.
many people, again, they like to throw out numbers and oversimplify things so they can just
Mhm.
say, well, this number's better than that one,
Yeah.
not understanding all the other things that go into it, all the assumptions behind it, right?
Right.
And of course, we're not showing here all the intangible benefits of the first lien HELOC. And the more I do velocity banking and infinite banking, the more I am aware of the huge intangible benefits that you get
Yeah.
from it that can't really be shown on a spreadsheet. But yeah, it is showing you that the first lien HELOC gives you a more efficient pay down schedule.
Yeah. Yeah. And I like what you said there, Logan. Like when it comes to the intangibles, to me, that sells the loan more than the rates.
Hmm. Hmm.
Definitely more than the rates, in my opinion, because I think a lot of people don't understand the psychology behind being in a mortgage, how it feels to be in a mortgage, how it feels when your back is against the wall. Like, I've said, I have a client who was 3 months in to his first lien HELOC, and he lost his job. Made 160 grand. He lost his job. Well, first thing he did was call me and say, "I can't thank you enough for the peace of mind I have." Right, and that's something that you really can't put an interest rate. That's not, you can't put a dollar amount on how it feels to say, hey, I can go and look for my next gig knowing that, I'm not going to get foreclosed on because I can't afford to stay here anymore. Right. But really, these numbers do work out very well. Now, there's another aspect that I would like to highlight as well, because this happens a lot where a person only talks about variable interest rate, and I think we have a nature of only thinking about negatives and not thinking about positives. It's funny how if you're investing, you only think about positives, right? Like when people talk about the market, their mentality is that they just never lose money until they lose money, right? But when they talk about interest rates and they understand the variability of that, they're more so like, okay, well, the interest rate could go up, right? Variable means both ways, right? So
Hmm.
it could go up and it could go down. So it could end up costing less,
Hmm.
right? But if we're talking about going up, I just want to show something really quickly. So I'm gonna jump it up to 10%. Now, 10% is an unrealistic interest rate for first lien HELOCs in today's environment. 10% is extremely high. Logan, is 10%, is the client still paying it off quicker and paying less money?
Yes, they're still paying less in interest and paying it off more quickly than with the mortgage.
Right. Now I'm going to do something else to show you the reason why people are scared of variable interest rates is because of how they act on a mortgage. So right now you see we have 4%. Let's just kind of remember this last number, this 194,047. So I'm going to act as though the person is in an arm. I have this happen sometimes. A person's in an arm, they were promised a percentage for maybe 2 years, and then it went up a little bit, and then went up a little bit, right? So I have that happen sometimes. Well, let's say the interest rate here only went up by 2%. Now, bear in mind, I had already put the other interest rate up by more than 2%. I increased it by two and a half, right? From 7.5 to 10. So let's take a look and see how detrimental 2% is on an amortized schedule. This
Wow.
number was 197.
194, I think.
This
Wow.
number was 194, right?
Made a
Why,
massive difference.
why are we showing this? Because when you say it's a variable interest rate, what really you should be saying when you're talking about a HELOC is not that it's a variable interest rate, is that a person has a variable income, right? If or maybe they're starting to spend more money, right? And I set the I set the table, right? I tell the person I don't trust them. I don't trust them to actually stick to the schedule 100% because nothing is perfect. Nothing is perfect, right? So
Mhm,
why I don't trust you to stick to the schedule 100%? Because I think, you're going to have to pay for your kids for graduation. There's going to be random expenses like that come up, right?
mhm.
There's going to be trips that you want to go on that you probably could never afford before because you didn't have access to the equity in your house and you want to take your wife somewhere nice. Okay, I understand that those things will happen. But when you're in a mortgage, that hurts. When you're in a HELOC, that doesn't hurt as much. The manipulation of that is not terrible as long as it's not a monthly habit that you've developed that has gone crazy because the calculation is based on the current month, the daily interest of the current month.
Yeah, and I want to go back to something you said earlier about how when it comes to investments, people only think about the positives. But when you show them something like velocity banking or infinite banking, they only think about the negatives.
Mhm,
And I think it really just gets back to conventional wisdom, right?
mhm.
There's a natural confirmation bias where they want to believe the conventional wisdom. They want to follow it and they'll only talk about
Absolutely.
the positive. The market only goes up and it only goes up at 12%. And that's going to happen for the next
Absolutely.
30 years. And yeah, there might be ups and downs, but I'm gonna win over the long run, right? Just so that they can justify what they already were going to do anyway, which is just put their money in a 401k or whatever, and not think about it too
Right.
much. When they're presented with an alternative that is not conventional wisdom, they just reflexively find any excuse to reject it. What if this? What if that? What if this? What if that?
Mhm.
I'm like, why don't you have these same questions when you sign up for your 401k and you just automatically put a certain amount away where you can never touch it, basically,
Right.
right?
Right.
Because
Right.
I don't think that asking negative questions and looking at worst case scenarios is a bad idea. But
No,
why
I
don't you
agree.
apply that same logic to all these other more conventional instruments where the worst case scenario, in my opinion, is a lot worse, you know?
Yeah. It's a saying about the devil right?
Mhm, mhm,
I think a lot of people they get really comfortable with the devil they know, so much so that they forget that it is a devil,
mhm.
right? So it's
And
like,
because if their neighbors are going through it too, there's safety in numbers. They feel like, yeah, it's all right. We all
right,
got hit by the market going down. It's like, well, you don't have to, right?
yeah, yeah. I mean, struggling with other people is not necessarily a positive, just because you have that in common. I want to have in common that we're succeeding, right?
Mhm, mhm,
Or even if I don't have it in common, it's something. I think I was watching a video from Nelson Nash recently, and it was about just like the herd mentality and how
mhm,
he had met with his client, and the client was like, "But how many people in my area do this, right? How many of them also engage in this?" And he was like, "Okay, so let me ask you this: if 99%, like, if you were in a room and it was 100 people and you were one person, and 99 people were doing it wrong, would you do it wrong just to be comfortable?" And I was like, that is such an astute point because I think that we oftentimes forget that we kind of operate in silos. Like there's certain things that you like that I don't like, right? Or things that you do that I don't do. Maybe
mhm,
you're a fisher, right? You might go in your neighborhood and there's not that many people who fish. But then you're able to find people who fish because that's how you adjust your filter. Like you look around for people who are interested in fishing. So then you end up finding more of them. I think when you're talking about first lien HELOC, maybe it's not in your immediate area, right? That somebody is doing this.
mhm,
Um,
mhm,
but certainly there's communities of people who are engaging in in first lien HELOCs, velocity banking, and those communities are well online. You can see all of these people who are, who have their testimonials, who are actually practicing this. I think people have to kind of get out of the local tribe kind of mentality where it's like, but the person down the street isn't doing it. I mean,
Which I've never understood that either, because the people you're talking to are not billionaires.
right,
So why would you wanna do what the
right.
average person is doing when the average person is
They're,
not getting rich?
they're not doing that
I
well.
don't wanna do what the 99% of people do who never get ahead. I wanna find the 1% who are actually doing well, right, and imitate them. So I've never understood that,
Yeah,
why people are just reflexively looking for approval from somebody else who's not even an authority figure. Your
right.
next door neighbor is not Warren Buffett, so why are you trying to get financial advice from them? They're probably struggling even more than you. Why would you do that? I don't
Yeah.
understand. I've never understood that.
And most of the and it's funny you bring that up because when I have conversations with clients, I tell them that um most people don't follow Warren Buffett's advice.
Mhm,
Like
mhm,
most of the people who talk about buy term and invest the difference, they don't follow Warren Buffett's playbook.
mhm,
So I'm curious as to why are you so gung ho about investing if you don't follow the advice of the person who's the number one investor, right? I mean, when Warren Buffett talks about risk, he actually categorizes risk as a lack of knowledge, right? So he's like, the only reason why you diversify is because you don't know enough about one thing to go
mhm,
all in, right?
mhm,
And so you can't mitigate your risk because you're not knowledgeable enough. And
mhm.
that's the reason why he doesn't have that many different shares. He knows what he wants, he picks exactly what he wants, and then he's good, right? And I think that that's just something missing in people's lives that they're so engaged in a short answer that they're willing to just spread out, just take whatever advice comes to them that is conventional, but not from the best at what they do, right? Because to me, it's like, when I tell people about investing, I'll say, hey, you're not investing if you don't know what you're investing in. You're speculating. You're not investing. You should actually know, hey, so and so's wife just left him, and that's affecting that stock, right? Um, People are not getting that involved in their mortgage either, right? They're not getting, if we were to do a realistic calculation of what the 30, like of what the apples to apples is, because I could say this is apples to apples that I just showed you where it's 30 years, 30 years. Like let's most people never pay their house off. Like
Mhm,
let's go ahead and get that out the way. So
mhm.
all the comments that's talking about, oh, this would work better and this would work better. Well, why is it so few people who actually get to the point of paying their house off? Right. So,
Right.
you'd have to be realistic about that. Well, what are they doing? Oh, I'm doing an addition on the house. Oh, or this or this happened, right? And it's like we're trying to give you a solution that is working for people,
Right,
right?
a practically workable solution. And yeah, it's the same thing with investments where they just put out these, projections that are totally meaningless, right? And to your point, yeah, it's like most people are never paying the mortgage off. It's not 30 years, it's never,
It's
because every
never.
5, 6 years they refinance it, pull equity out, use it, do whatever, and they never even get past year 5 in the amortization schedule. So they're always making the least efficient payments, right? Paying the most in interest and
Yeah.
using the equity or what have you. So if we're being realistic, we should
Yeah.
stretch that out. Like here's what it would
We
look
should
like if you had a
we should
mortgage payment
stretch
for
it
the
out
rest of your life,
indefinitely. Yeah,
and you're always in the first 5 years of the amortization table
yeah,
where 80% of your payments are going to interest. If we really wanted to be realistic, that would be the comparison we would do, right?
I
So to your point, with the standard conventional wisdom, they're always assuming best case about everything.
mhm, yeah,
Whereas with the alternative, they're always going to come up with all these worst case scenarios. What if this happens? What if I lose my job? What if this? What if that? What if this? What if that?
mhm,
Which, yeah, those are good questions to ask, but why don't you have those same questions when you're presented with a conventional 30-year
yeah,
mortgage or when
yeah,
you're presented with your 401k or buying mutual funds? Why don't you have those same questions, right?
yeah,
And it's not just about what is the market going to do, it's about what is my personal situation going to be like? What if I
exactly,
lose my job? What
exactly.
if I have a sick child or what have you, right? These things do happen.
Yeah,
These things do happen.
absolutely. It's funny you bring that up because it's like if I was to show people my log of how many 66-year-olds just bought a house last year with a 30-year mortgage on it, it would be staggering. It would be staggering. Like people are not paying off they're getting into the loan knowing they're not going to survive to pay the loan off. Like,
Hmm.
put that into perspective. That's a reality for the average person. The average person is not paying off these loans. Um, I have some clients who come to me, they've been paying on their loans for 40 years. They've been in the same house for 40 years. That's a rarity, but why are they still paying on it? Why is there still over $200,000 left on a loan that started off at obviously a lower place because the house values have
Hmm.
gone up drastically? It's
Hmm.
because of the behaviors. So while you're saying, "Hey, this doesn't work," you also are not making room for what humans do, right?
Right.
What habits people have.
Right.
So, and I'm not saying that I'm perfectly representing what habits people have, but I will say in a 5-year span, I have a better chance of replicating that than I do in a 40-year span, in a 30-year span, right?
Yep. Yep.
And so, it's almost as people are acting like they don't meet people who keep refinancing for 30 years to lower their payment. Because people are not concerned about paying the house off. They're concerned about making the payment manageable for themselves. That's what they're concerned about, which is why they stay in the loan forever. Right. So
Yep. Yep. All right. So let's go a little further. Uh, we could go on all day about the intangible benefits
yeah,
of the
absolutely.
first lien HELOC. Okay.
Absolutely.
For starters, who pays for the remaining 48,000? So again, this is we already
Right.
answered this. This is explaining why,
Mm.
why is the principal amount different?
Right.
He's not understanding how that spreadsheet works, which I can understand why that's confusing if you're not sure how to
Yeah,
interpret the
I
spreadsheet.
understand that too. So
It
we
looks like we're artificially handicapping the mortgage by putting a bunch more in principal. That's
absolutely.
not what's going on. It's how the amortization schedule works. Okay. It is being claimed that the HELOC replaces the mortgage, which bank allows you to place a $270,000 mortgage loan with a $220,000 HELOC loan. What universe is this from? Yep. So we
Right.
covered that, right? The reason is
Right.
because you only have $220,000 left,
Right.
right?
Right.
You're
Correct.
8 years in. Okay.
Mhm.
Second, in the spreadsheet for the mortgage, a payment of less than $2,000 is made monthly versus a payment of over $4,000 monthly for the HELOC.
Correct.
Now, this I think is a good one to go into. So on the surface, it seems unfair because you're saying, look, I'm only paying $2,000 a month on the
Mhm.
mortgage, whereas we're paying over 4,000 for the HELOC. So DeAndre, of course we're going to pay off the HELOC faster. That's not a fair comparison.
Yeah.
You want to address that?
So he's correct, right? He's correct. When you're talking about a first lien HELOC, the magic of it is being able to blitz the payment on the house with all of your income because you can reach back and use the money for anything else that you need to use. So this really kind of attacks the sentimentality of your dollars, right? Like if you went to a person and said, "Hey, why don't you put down an additional, or why don't you put down the difference between your income and expenses on your mortgage as a principal payment?" Nobody would do that. And the reason why they wouldn't do that is because they are terrified to do it because, well, what about my emergency funds? Well, what about saving for this? Or what about saving for this, right? They would not have the option to do those things. So, what the HELOC is inherently doing is it's just opening up the space that every dollar that you put into it becomes visible for you to use now. So, yes, you are correct. We are definitely paying more onto the loan than the mortgage in that situation. But I believe we've also done a paid double mortgage example too in one of our videos,
Right.
just to kind of conquer that particular statement. But
Right.
uh,
And when he says here's what I would say. When he says you're paying over $4,000 to the HELOC, no, what you're actually doing is you're running your cash flow through
running your
your
cash flow,
first lien HELOC. So
Yeah.
that's again one of the beautiful psychological benefits to the solution is you are not consciously doing anything differently,
Right.
right? It's
Right.
happening behind the scenes. All you're doing is just depositing your paycheck and spending like you normally would, but behind the scenes, that paycheck is getting applied to your home equity, right? So you are not consciously doing anything differently.
Mhm,
And yeah,
different.
to your point, DeAndre, you could make those additional payments to the mortgage, and we've shown how that's still less efficient. But the reason why people don't do that is because you can't pull that money back out. If you
Right.
dump a bunch of money into your mortgage, you don't have access to that money anymore. So people understandably don't do that. And I would not recommend people do that,
Right.
right? With a HELOC, you can do that because you can pull that money right back out. And in fact, that's what we're doing at the end of the
Absolutely.
month. And let me correct him a little more. It's not the 4,000, it's your total income
Yes.
that goes into the HELOC. This is really important. This is something they don't cover in the first lien HELOC presentation, but I like to cover. To say you're making, we're actually handicapping the HELOC,
Hmm.
right? Because we're only showing the net amount of monthly cash flow that you have going to pay down the HELOC balance. But actually, the gross income that you earn will all help to reduce the HELOC amount. The reason is because let's just say you have $10,000 coming in at the beginning of the month and you're going to spend that full $10,000 at the end of the month, okay? If $10,000 hits your checking account, it sits there for 30 days and then you spend it, that $10,000 did nothing for you. It's gone, right? In this example, $10,000 hits your HELOC balance, so it drops your principal balance by $10,000. And
Hmm.
then at the end of the month, you pull that $10,000 out. So what happened? It reduced your average daily principal balance for 29 days. Therefore, it reduced your out of pocket interest costs without you changing anything you're doing. You still spent the money just by running it through your HELOC, though, you reduced the amount of principal, the amount of interest you had to pay out of pocket. And that's an additional advantage that we're not even including in the spreadsheet calculation. So this will actually
Yeah.
go even more efficiently than what we're showing, right?
Yeah. And that's another reason. I'm glad you mentioned that because that's another reason why I tell clients that this is just so that you understand the concept.
Hmm. Hmm.
If you're adding, hey, I want you to financially tell me what's best to do.
Hmm.
Well, just from a calculation standpoint, if I understand that it's based on the daily average, then that means I would just not let my expenses come out until the end of the month.
Hmm.
Right. And
Hmm.
that would definitely better how well and how efficient
Right.
it will be. And it's
Right.
going to make it so that I effectively change the interest rate I was charged.
Right.
Right.
So if you're paying your bills, whenever you get your paycheck, you want, let's say you get your paycheck at the beginning of the month,
Mm-hmm.
you could change all the due dates because oftentimes you can to be the end of the month.
The end of the month.
So by
Absolutely.
adjusting all your due dates to be as late in the month as possible, right, you benefit yourself even more, right?
You're spot on. You're
Which
spot
normally there wouldn't be really any benefit to doing that, but in this case, there is.
spot
That's a
on.
more maybe a more advanced use case. So again, he said, "Why did you not compare the same payments in both cases?" Hmm.
I did
And
now.
again, to the point to your earlier point, the reason is because if you're not doing velocity banking, then the first lien HELOC makes no sense, right?
Right.
The
Correct.
first lien HELOC only makes sense if you're doing velocity banking.
Correct.
So I will grant him, yeah, if you're not putting your income through the first lien HELOC, it doesn't make nearly as much sense,
Yeah.
right? If your
That's not
plan is
what it
to
was built for.
right,
It's not
right.
what
So it's a totally unfair comparison, right? So again, and again, I would say it's not that you're making additional payments to your HELOC because you're not consciously making any additional payments. What you're doing is you're running your income through the first lien HELOC, and then without unbeknownst to you, right, you see your balance dropping down. And by the way, talking about we could go on all day about the psychological benefits, how people see their balance going down so much faster. It creates a virtuous cycle.
right.
Whereas with the mortgage, it's a vicious cycle because after year one of being in a mortgage, your principal
It
balance has barely moved,
hasn't done
right?
anything. Yeah.
Whereas in your first year being in the HELOC, you see
Mhm.
that principal balance drop down and it creates a
Yeah.
virtuous cycle. Right.
and I'll also note this, because I don't think he's making room for this. And what you were stating about really the automation of it and
Mhm.
why that's so important.
So important, so important.
Human error is the detriment to any strategy that you could put forth. It doesn't matter what the strategy is. Your execution is going to be what tanks anything, right?
Mhm.
I don't mean that to
Mhm.
say anything wrong, but in my appointments, I meet people who had reverse mortgages or their parents had reverse mortgages, and they said, "Oh, I would never get a reverse mortgage. It took my mom's house." Well, your mom didn't have life insurance on herself to pay off the reverse mortgage when they called the loan when she died, right? There are different ways as the user of the loan to procure that it works the best for you. The mortgage is very difficult because you are the person trying to make these decisions and send these checks out at certain times, right? So
Mhm.
if you got in a crunch of a time, you got in a bad situation, um, you would hope that you saved up enough to have the mortgage payment, right?
Mhm.
Consistent. But if you haven't been building up an emergency funds, which is the case for most Americans, then you're toast. And what happens? Foreclosure, right? Now, when you automate this process and you say, hey, we're just going to make sure that this happens without you actually having to make a decision, that taking the emotion away from you of sending out a payment, it makes all the difference in the world of this concept. And
Yes.
that's something that you can't calculate. I know that's hard for you to understand at its base,
Right.
but it is something that you really can't wrap your head around until you just walk around and all of a sudden it's like, oh, I'm just living my life and my principal is just dropping rapidly, right?
Yep.
Rather than, well, let me try to save up enough to do double the payment. Let me try to save
Mhm.
up enough to do this, right? And what's going to happen is your life is going to happen, and you're going to have a flat tire, and your engine's going to go out, and your baby's going to need something. You're going to need something, and you're going to defer to those things before deferring to blitzing paying off the house. So, to be clear, there is almost no one who actually continues to pay double their mortgage payment straight consecutively every single month,
Mhm.
right? That number is extremely low.
Right.
And in order to be that, you have to be making such an amount of money and to also be guaranteed residual income to facilitate that. That's just not the case for most Americans. So I think that a lot of people, when they comment, they may not think about the people in their circles who are struggling with having a mortgage payment, like, and, budgeting it out and being dreadful about having to send out that mortgage payment.
Right. I remember someone who was an expert in helping people pay off debt, and he talked about all the different methods: velocity banking,
Hmm.
snowball method, debt avalanche, all this
Hmm.
stuff. And he said, you know what? All of them work. They
All of them.
all work. It's more a question of human psychology, right? Than it
Absolutely.
is a question of methodology, right? Because you can numerically show how one method is better than the other. That doesn't mean it's better for you,
Hmm.
right? And one of the beauties of, again, velocity banking is that you don't have to consciously make any additional payments. So I try to be precise with what's going on conceptually, because
Hmm.
conceptually, what's happening is not, I'm making a bunch of additional payments. No, that's not what's going on.
Yeah.
What's happening is you're running your cash flow through a more efficient vehicle, and you are not consciously making any additional
Mm.
payments. And that's really important. So when people say you're making all these additional payments, well, not really. Not really. And that's important. That's an
Yeah.
important distinction to make.
And
Yeah.
another highlight of the automation, um, you understand automation when it comes to 401ks.
Wall Street certainly does. They
Wall
certainly do.
Street Wall Street understood that it can't trust the person to budget themselves to actually save for their retirement officially, right? So did pension systems, right? So they just took it out before you got it. The 401k does the exact same thing. The HELOC is doing the exact same thing. It is automating the process to be more efficient. The
Mm-hmm.
difference, though, is it's automating it on something tangible as a result. Paying off your house is tangible. How much you're going to have in the market is not tangible. You don't
Mm-hmm.
have a guarantee that because they're taking 6% of your checkout that it's going to be worth this much. That
Mm-hmm.
is guesswork, right? Now, granted, it's better than doing nothing. I'll agree with that for sure. It's better than doing nothing, but is it tangible for what you lost? No. You took a tangible loss of 6% of your check
Mm-hmm.
to fund something that was intangible. Here, you have the tangibility of I can actually see my house being paid off quickly. And I'm not forcing the issue. I'm not making a whole bunch of additional payments trying to budget that out.
Absolutely. Absolutely. Okay, so let's continue with his comments. Okay, as if this were not enough, the spreadsheet claims for month one of the $270,000 mortgage, the interest payment is $1,687. This is wildly incorrect. The correct interest is about $900, much lower than the HELOC interest at some $1,400, even though the amount of the HELOC is only $222,000. Obviously, the HELOC interest rate of 7.5% has been used to calculate interest for the 4% mortgage. At best, this is an error. So basically, as is to be expected, the HELOC costs much more in interest and is not cost efficient. So he's claiming that you've got an error in your spreadsheet, DeAndre.
Okay, so first and foremost, I would he said it was how much? 1687?
He says the spreadsheet claims in month one the interest payment is 1687, and this is probably getting back to the same reason why he's confused about the principal amount of the mortgage being 270 versus 222 in the HELOC. It's probably that same confusion, right?
He's saying that on the mortgage it says that?
Yeah, he's saying for month one of the mortgage, the interest payment is 1687. He's saying
Right.
that's what your spreadsheet claims.
Now that is kind of easy to refute,
Yeah,
right?
do you want to pull up the spreadsheet or
Yeah, that's easy to refute. I think now this, all of the other ones I can kind of bypass and say they were in good faith. This particular argument, I would say that you were not looking at the entire spreadsheet,
yeah, there you go. Interest payment $900,
right?
not
So,
1687. I don't know where you got
so
that 1687
yeah, so
number
I
from.
don't know where you got the 1687. Um, I mean, I don't know what preference you because it's nowhere on the screen,
Yeah,
right?
every time we
It's
it's
nowhere
funny,
on.
every time we get an objection, it's like we have to spend so much time trying to figure out what the guy
Right.
is even trying to say because there's so many misconceptions and misunderstandings behind it.
Yeah, because I have the
To
minimum
before we can
monthly.
even get to the substance of any objection, right? So
Right.
yeah, no, it's correct. There it is, $900. And by the way, as we pointed out, you're 8 years anyway. You're not
Yeah,
day
you're eight
one, but
years into it. So even if I were to drop it down to where the person's current interest is, so if that was the argument, which it wasn't because his numbers were wrong
so
even
when
from
he's saying
the
the
start.
HELOC interest is 1,400 for the first month, that's probably accurate because it is true that to begin with,
No,
the
it's
HELOC
higher.
will, yeah, the HELOC will be
Hold
higher
on,
in
let me
month
see.
one. Yeah, no question
Oh no,
about that.
I still have it at 10%. Let me go back
Yeah,
to 7.5.
7.5%.
Right? So yes, now
And
that
you got to
is
change the
incorrect.
principal to 222 as
Oh
well.
yeah, yeah, yeah. Thank you.
So no, the spreadsheet is correct, $900 as he said.
All right. So he may
So
be correct there with the 1387
yep,
50.
absolutely. And
Okay,
which we acknowledge. It is certainly
okay.
true that you are going to pay more in interest on the HELOC in month one.
In month one,
Yes,
absolutely,
that is true.
absolutely, right? Absolutely. No, I will not refute that at all. But his first statement was definitely incorrect. Definitely
Yeah, I
incorrect.
don't know where you got that number from. Maybe we can maybe he can tell us afterwards. So I don't know.
Yeah. Yeah. So
All right.
anything else from Thomas?
Oh yeah. Okay.
Thomas, what up,
So
man?
The reason that the debt is paid more quickly in the stacked up HELOC case is that the debt is magically not only lower to start with. Okay, so again, we addressed that.
We addressed
That's
that.
because of the amortization schedule, but
Mhm.
also that the monthly payments are much higher.
We
It is
also
not
addressed that.
rocket science. Paying more each month will eliminate debt quicker. Well, that's true. That's true. We are paying more again because we're doing velocity banking.
I agree with
Paying
that.
more each month on the mortgage will eliminate the debt even quicker and cheaper than using an expensive and risky HELOC. So I would question that categorization. So
Okay.
again, paying more each month on the mortgage, we actually kind of showed how it's actually still less efficient to pay more
So
on the mortgage. But if I might say a little bit more on that, let's grant for the sake of argument that this was true. Let's
right,
just grant for the sake of argument this was true that if you paid
right.
more on the mortgage each month, you would eliminate the debt more cheaply and efficiently. It's not true, but let's grant it for the sake of argument. I would say the HELOC is a lot less risky, even if it were more expensive, even if you ended up paying more in
Definitely
interest
a lot less
and
risky.
you ended up paying it off more slowly, it's a lot less risky because it's a two-way street. If you
Right.
plow a bunch of money into your mortgage and then something happens and you need access to that money,
Mhm.
you can't get it, right? If you lose your job, you can't qualify for any sort of cash out refi on the mortgage, not to mention, well, now that's adding more costs, even if you do get it, take you 30 days and all that, right? Whereas with the HELOC, you can pull it right back out. So I would say the HELOC is actually much less risky. So when he says
Yeah.
risky,
Yeah.
again, I think he's viewing it as risky because it's not conventional wisdom.
Right.
Once you understand it, you understand it's actually a lot less risky. And that's one of the big benefits. So, in my opinion, even if it were more expensive, I would still say it's a superior instrument for paying off your debt because you can do it with a lot less risk because you don't give up liquidity, right?
Right. So, and of course, I want to answer a couple of those things, right? So, because I want people to think about it not only conceptually, but how it feels to do what they're talking about, right? So, how does it feel, right? So, we're in the mortgage, we're 8 years into it, and we have an extra payment of 41.22. Now, I want to make sure this is clear. We're basing this on 41.22 from the start of the loan that you've been paying extra onto this. We're not basing it on from here on out on the 222, right? So we're actually giving you a head start, a major head start based on based on what we're talking about because your amortization schedule is deeper. And we're acting as though you've paid this 41.22 over the course of those many years beforehand. So I want to take a look at this though. What you see on the now, of course, yes, it was 270, right? That we were basing it off of because that was where it was at, but we were still basing it on the schedule that it's currently in. So when we take that 41.22, that is the amount that is going extra to the HELOC that wasn't going towards the mortgage. He's right. We do have a interest payment difference here, right?
Mhm.
So yes, we would pay more on the HELOC in that particular situation than we would pay on the mortgage. However, I'm curious, who can afford $5,938.99 locked away? And then now, when inflation comes, they still got the expenses that is outside of the mortgage. I think a
Mhm.
lot of people don't think about that. Like, life is also outside of this spreadsheet. So, as these expenses continue to enhance because cereal costs $1 more, eggs cost $2 more, tires and everything else that their life is actually costing more, you can't sustain paying that extra amount of money eventually. You're going to hit a brick wall eventually because of that. So that's number one. I just want to make sure that's clear from just a how it feels to actually be inside of the loan. and do what they're actually saying that you should do.
Mhm,
Now,
mhm.
the other portion I would say is, as you mentioned, risk is based on knowledge. So I want to acknowledge something. When it comes to first lien HELOC, there has been zero foreclosures since 2014. If it's such a dangerous loan, if it's so risky, how is that possible? Well, it's possible because they have you meet with people like me and Logan first, right? They
Right.
want somebody to actually go over your numbers. And even when you get in front of them, they go over your numbers again, right? To make sure that you are the right fit for this particular loan. They are willing to turn you away if it's not going to be helpful. And they do it all the time, right? Um, Now, let's make a comparison. If we were to talk about the mortgage, the 30-year mortgage, in 2023, just in the first 4 months, there was over 100,000 foreclosures. I didn't say from 2014. I said just in 1/4 of 1 year, there was over 100,000 foreclosures.
And most foreclosures are due to health issues, not even the market crashed.
Yeah,
Health issues, right?
yeah,
So again, we are talking about things that are much more tangible, concrete, specific to the average person's experience, not some hypothetical rate of return in the market where even if you do get it, it may not matter, right?
right, right. So we want to make sure that like risk can be calculated. Risk can be calculated. If you're going to say it's more risky, you have to provide data that says that
Right.
there's more people who are struggling, more people who are,
Right,
losing
exactly.
their
They
house.
use
Yeah,
words like expensive and risky as incendiary terms. It's like, wait a
right.
minute, quantify that. You say it's expensive. How much more expensive is it? Quantify that. You say it's risky. Quantify that.
Amplify
And
that.
as you've shown by using for one of these numbers people, numerical data, zero over an almost 10-year span versus more than 100,000 over a 4-month span shows you the amount of risk is exponentially higher with a
Yeah,
mortgage than with a first lien HELOC.
absolutely.
So you actually quantified it, right?
Yeah,
And same thing with expensive. We've shown how it's actually, if managed properly,
right.
a lot less expensive. But you know what? If you're not managing your finances properly, your whole life's going to end up being a lot more expensive, right?
Well, if you're not managing your finances properly, there's a high probability you won't even
Yeah, you're not
qualify
going to qualify this. Yeah, yeah. No, you're
this,
not going
right?
to. This is only for financially responsible people. And
Yeah,
to your point, DeAndre, if you want to talk about expensive, we have to look at it in the context of your overall financial picture. We cannot look at any one financial product in
yeah,
isolation. So, what if this first lien HELOC allows us to refinance your other debts into the HELOC? We can get rid of your credit card debts. We can get rid of other debts that may be robbing you of cash flow, even if they don't have super high interest rates. It's taking some of your cash flow. If we refinance those into the first lien HELOC like we do all the time,
that's the
guess
main
what?
thing. Yeah,
Guess what? We just made your overall financial picture so much better. And that's not accounted for in the HELOC versus mortgage
it's
comparison because
not.
we're trying as best we can to make it an apples to apples comparison, but it can never be perfectly apples to apples, right?
Yeah, that's a good point. And then let's ask the question then, is 7.5 better than the 21% on the credit card? Is 7.5 better than the 29% on the credit card? Is it better than the loans that you have out that have been just lingering for forever and they're costing you $600 a month,
And
right?
is it better for you to put your money into a debt instrument where it's a two-way street, where you can put money in, pull money out?
Look back
And
out.
from day one, unless you're buying a house with a first lien HELOC, in this example, you're not, you're refinancing.
Hmm.
So what if on day one, now you have access to $200,000 worth of equity that you didn't have before? Now you've got effectively a $200,000 savings reserve to fall
Hmm.
back on that you did not have before,
Yeah.
right? I was in my financial malpractice series.
Good
part
point.
10, where I went through a potential solution for the 75-year-old, he didn't really have any cash, right? And so how did I, as a financial wizard, magically come up with cash? Well, he had a paid off house. If you take out a reverse mortgage in his example and you're paid off out, all of a sudden you've got a $220,000 line of credit that you can access with no repayment terms. Boom.
Mm.
Now you have $220,000 of liquidity that you didn't have before,
And
right?
just get a life insurance policy to cover the debt,
Yep.
right?
Yep. That was in there too, and an annuity, right?
Yeah,
You know,
people need cash flow, man. It's interesting that you also brought that up because that's an intangible that I also bring up that hey, when you see this mortgage versus HELOC calculator, you're not seeing the full picture because I'm not showing you what the value of your house is, right? Like if we were to compare what you saw on the screen, and it's funny because people get upset about some comparisons, but they don't mention the other ones that could be valuable too, right?
right, right.
So, so for instance,
Yeah,
when we
we could
look at
complain and say, look, it's not a fair apples to apples comparison because we're
right,
not showing you your total line of credit, which is a lot more than
we're
the loan
not
amount,
right,
right?
and so it's like, yeah, okay, you got 270,000 as your principal loan, and this was 8 years ago.
Hmm.
How much did the house increase in value over 8 years?
Right.
Okay, you got 222,000 on this side as a loan amount. But what's the difference of what you already have available now versus,
Right.
so
So it'll be so 90% of the value of your home minus whatever your current outstanding loan amount is.
yep,
That's how much liquidity you will instantly free up.
that's what you will have instantly. You can't you can't quantify that for a person who has who has some debts that they've been needing to clean up, that they didn't know where they were going to get the money, and now they can just tap into the first lien HELOC and actually snowball all of this debt more effectively. You can't quantify it.
Right.
You just can't
Or
quantify it.
you use that liquidity to fund a whole life insurance policy.
Yeah,
Could you use that
can't quantify
liquidity
it.
to buy a rental property, right?
Yeah,
Could you use that liquidity for, I don't know, other investments depending on your investor DNA, whatever makes sense for you, right?
it,
Could you use
here's
it to start a business, right?
Here's something that I've been doing lately because I think, and this is something in the insurance industry that doesn't happen often, but a lot of people don't annuitize annuities. Most of the time, they don't annuitize them. But the reason why they don't annuitize them is because the client still wants to have access to a lot of capital. Like they don't want to just have only their income. But now, if you had a HELOC, you could annuitize it and be guaranteed your income forever. You could have a contractual guarantee. I sat with a guy the other day, $200,000. You put it into the annuity, give it 7 years to defer. You got a contractual guarantee from the insurance company that will give you $28,000 with no income reduction for the remainder of your life. Put that into context. What would $200,000 do in your 401k from a withdrawal rate standpoint? It's 8 grand. It's 8 grand.
And there's no guarantee
And there's
that
no
it'll last.
guarantee there that
It
it
will
will last,
probably last at
right?
that level, but there's no guarantee.
So, I mean, you could reverse your clock with a HELOC by putting the money in the right places, getting the guarantees that you need to make sure that your life is easy and what you want, at least that your needs are taken care of, and even your wants if you wanted to,
Yep.
right? What
Yep.
Tom Heckler says, paychecks and playchecks, right?
Right.
That's one of my favorite things.
So, Mr. Thomas, I want to again thank you for
Thank
commenting.
you,
We appreciate it.
because he wasn't
Uh,
disrespectful, so we
no,
appreciate
no, he was not. We
for
appreciate it.
your
We appreciate
conversation.
a lot
Um,
of extra punctuation in there in all caps. But
oh
no, I
yeah,
mean, we
yeah,
appreciate the commenting. And I think his confusion is totally understandable because of the way the spreadsheet it shows. It does appear as if we're
I
being
agree.
unfair
I
if
agree.
you haven't been through it and understand what's going on behind the scenes. So I think that was a totally fair
Yeah,
point that he made and gave us an opportunity to clarify it.
yeah.
So thank you for commenting. Thank you for the engagement. He commented on another video, which we will address in the next one. But
Okay.
hey, keep the comments coming. We're
Keep them
totally
coming.
open to
Appreciate it.
alternative views, and I think this gives us a great opportunity to address,
Yeah.
the typical objections, so that people can understand. Um, people can understand why they might want to go against
Hmm.
conventional wisdom, right? Um, so
Absolutely.
thank you so much for your time, DeAndre. Really appreciate it.
Thank
And
you,
we look
Logan.
forward
It's
to the
always
next
a
one.
pleasure, brother. It's always a pleasure.
All right. God bless everyone. Bye bye.